Hi friends, welcome to today's video. Today's video is about understanding the concepts of options contracts and 5 things you should know before investing in options contracts. Welcome to my channel. My channel is centered towards sharing the information on financial concepts in short videos, so it may help you become a better investor. If you like the content, do subscribe the channel and like the video so it may help the other people to understand the financial concepts. So what is an option contract? In an options contract, an investor has the right but not the obligation to buy or sell a stock or an index at a certain price. This transaction can happen at any time, provided the contract is valid. Options represent financial products that investors can make use of for making returns or to act as a hedge against any current investments they possess. It allows any investor to purchase any investment at a particular price by a particular time and date. Before getting into how options actually work in a practical scenario, it is important to understand options meaning in a little more detail. Options are a form of investment that deal with derivatives. They could be offers to purchase or sell stock or index, but they do not really represent the actual ownership of the underlying investments, at least not until the agreement is final. Typically, buyers pay a premium for contracts in options for a certain number of shares of stock or units of an index. Premiums are indicative of the asset's strike price, which is essentially the rate to purchase or sell until the contract expires. This is the date that indicates when the contract has to be used. Now, let's understand the 5 things you need to know before you enter your first options contract. Number 1. Buying options means limited risk, but you rarely make money buying options. Many small option traders prefer to buy options because your risk is limited to the premium paid. The problem is that globally, over 96% of the options expire worthless. That means, if you buy options, then you just stand a 4% chance of making money on options. The truth is that option sellers take a higher risk and therefore they make money more often compared to option buyers. So don't just get carried away by the argument that your risk in buying options is limited. The truth is that your prospects of making profits are also limited when you buy options. Number 2. Options are asymmetrical, and that is the difference. Let us understand this with an example. An investor named Ram is bullish on Nifty index and buys a Nifty call option for a premium of Rs 500 at a strike price of Rs 17,000. Another investor named Tony sells this option, then the trade is asymmetrical for both the parties. If the price goes to 18,500, then Ram makes a profit of Rs 1,000. That is, 18,500 minus strike price 17,000 minus premium paid Rs 500. In case the Nifty index remains below 17,000, then the loss for Ram would be Rs 500 for premium paid to avail the call option. In options, the buyer's loss is limited to the premium paid, but the seller's loss is unlimited potentially. Number 3. Always trade options with stop losses and profit targets. This is true of all leverage positions. While trading in options, your primary focus is that of a trader and not as an investor. Therefore, your focus should be on protecting your capital. That is possible only if you define your loss and profit for each trade. Stop loss is a discipline, so don't try to second guess it. Irrespective of your view on the stock or index, the stop loss levels and profit booking levels have to be adhered to religiously when you trade in options. Number 4. Keep a constant eye on the costs that you are incurring in options trading. If you think that brokerage and other costs on options are lower, then think again. In percentage terms, they may be lower than on equity, but you trade more frequently in case of options. These costs add up to a greater extent. You pay brokerage, GST, stamp duty, statutory charges on options trades. If you sit down and add these up, you first need to get a perspective. Ensure that your ratio of profits to transaction cost is better than 3:1 to justify your effort trading in options. Number 5. You can trade options even when you are not sure of direction of market. The ability to adopt a non-directional strategy is one of the most enduring features of the options market. Options can be used to profit in volatile market. At last, trading in options is nothing like the rocket science that is normally made out to be. A proper understanding will surely help you make better use of this innovative financial product. This brings us to the end of the video. Give a thumbs up if you liked the video and do subscribe to get a notification for upcoming videos. Goodbye and have a nice day.